To BQ Prime, you're joining us on this special conversation with Mr. Murali Ramakrishnan, the MD and CEO of South Indian Bank. Mr. Ramakrishnan, welcome to this conversation. Thank you so much for taking time out to talk to us. Mr. Ramakrishnan, firstly, let me quickly start with the results, because that is the most recent trigger for South Indian Bank. You've got a net profit about 223 crore, highest ever NII that you have reported. The asset quality position is improving significantly. Just if you can just take us through what the quarter looked like for you as the CEO.
Yeah, I think this quarter, in many ways, it's really a very satisfying quarter for me because, as you know, this bank, if you look at the journey of this bank from the time I took over, which was October 2020, there were many things which needed correction, and a lot of activities, a lot of actions which I was taking as part of our strategy from October 2020. And that was a time when COVID was also at its peak, and then we had the COVID-2 hitting us, etc. So many actions which we were taking basically to correct the structure of the bank and in bringing out the changes in processes, products, really bringing in the change in behavior in the entire team, creating verticals for assets, creating a strong focus for liability franchise, working with a very clear goal-oriented deliverable. I think all this actually have been happening for many quarters. Clearly, we had to improve on our PCR, etc. So even though we were making money earlier, many of them were set aside towards improving our PCR. And during COVID also, we had huge slippages happening in those 2 years. We had close to 4,300, 4,400 slippages. So clearly, we had to provide under those circumstances. And last 3 quarters, if you see, things have been pretty stable in the sense that economy has started showing good improvement. We have actually started seeing growth in our own book from the December quarter of last year. So therefore, the year ended March, the first quarter ended June, and the second quarter ended September. Clearly, we are able to put things in place, and you are able to see the results of it. So in many ways, it's like sort of communicating to me and to the entire stakeholders that we are on the right track, and all the actions which we have been taking to saturate the course of direction of the bank is now bearing a lot of results. And I'm sure we are still on our journey to make it better and better.
Okay. In terms of the asset quality position, let me just start with that, and then I'll come to the rest later. You said that you had to set aside more in the past few quarters because of you wanted to improve your PCR. Where does the PCR stand at this stage?
As of now, see, there are 2 measurements for PCR. One is with including write-off. The other one is including write-off. Including write-off, we are currently at about 72%. We were at about below 60% at some point in time, and now we are at about 72%. In fact, regulators' prescription at that point in time that I should take it towards 70%. That was the clear mandate from them, and we had given a specific calendar by when we will reach that thing. And I'm happy to say that we have reached it earlier than the timeline which we gave for regulators. Sure. Excluding write-off, which we were very low at about 32%. Today, as I'm talking to, we are at about 57, 58% kind of level. And the first milestone is to take it to above 60%. And clearly 65% is what aspirationally we would want to reach by either by March or by June of next year.
This is excluding write-offs, 65% that you're looking at. Yes. Got it. In terms of the current position of the book, now, of course, you have provided significantly till now. But going ahead, are you expecting that the asset quality could see some stress with the overall slowdown in the global scenario?
See, one is I don't really expect an overall slowdown to happen significantly, because if the concern is that the interest rates are going to go up and therefore that's going to slow down the asset, at least we haven't seen that. See, you've already seen from 4 to 5.9, almost 1.9% increase in repo rate for the last few quarters, and you have not seen any asset slowing down at all. In fact, every bank is now chasing more liability to meet up with the asset demand. So therefore, and the usual concern that higher interest rates will probably deter people from taking loans is a very logical conclusion. But then you should also remember that the rates were abnormally low for many, many years during the last few years. So, however, the people's demand over the last 2 years due to COVID was also sort of cooled down, because people were not wanting to go and spend money in a car or a home when they had difficulty even in terms of going to office, or some of them have to take cuts in their salary. Some of them lost their jobs, etc. Clearly, the demand was also very, very low, and that was very clearly evident from the GDP growth, which was -7% for the year ended 21. And if you remember the first half of that year, we had negative growth of almost 27%. But then it managed to sort of revive, and at the end of the year, we were at about -7%. Last year was the first year when we saw GDP actually growing, and I'm sure things are now looking better. So my sense is that there is clearly a pent-up demand for consumers to take more and more loans. And given the fact that rates are going to be firming up, smart people will also probably try to lock in rates at this time, especially in retail where it's a fixed rate. People would like to lock in their rates.
But how does that work when most lending is floating?
Obviously, a home loan, etc., is still floating. But there again, if you see, I think even today, even with the loading of all that for a good prime customer today, he gets it at about, let's say, 7.75 to 8.25% kind of rate, which is still very, very good rate. I mean, I remember when I used to take home loan, etc., even for a good customer like me at that point in time, it was never low. Therefore, I'm saying that's one side. The other side is in terms of the thing which you talked about, whether the book carries any big issues, etc. See, I would like to put it this way. We had a huge slippage of close to 4,300 crores in the 2 years of COVID. But if you look at my credit loss, which used to be much upwards of 3% and 2.5% last few years, it's clearly I'm giving a projection of close to 1.25% kind of level for this year. So clearly the fact that it is showing a downward dip, and I've given a sort of guidance of 1,600 crore slippages for the full year.
Sure.
And if you look at my H1 slippage, it's pretty much into slightly more than probably the half yearly, but I'm sure we will be able to bring it under control in the second half. My collection efficiencies are much above 100%. The other thing is the existing book today has been churned very well with the new book, and new book is impeccably clean. If you look at my new book, where I've added close to 34,000 crores of new book from October 20 onwards, it's showing a slippage of GNPA of 0.03%, which is like impeccably clean book. So the more and more I churn my legacy book with a new book, which I'm insisting on good quality book, I'm sure you will be able to see clear directionally it will be moving towards better quality book, and to that extent obviously provisioning etc will keep coming down. And given the fact that we are already provided with a good PCR, I'm sure the impact of provisioning on my profitability will be lessening as we move forward.
So in terms of your part of your asset growth strategy, now gold loans are one area where you had strong growth. What other segments are you looking at, firstly? And secondly, the second part of the question is on the gold loan portfolio itself. How long do you think this pace of growth can continue for you?
See, first of all, I won't say that my gold loan is the one which is contributing to my growth. If you look at this delta which has come from various businesses towards this growth which I'm talking about, I think it's a fairly significant contribution from 4 or 5 product lines. Corporate banking corporate group has advances have grown significantly. My PL book has grown significantly from almost zero base to currently we are now averaging close to 125 to 150 crores kind of disbursement per month. And I'm standing on a book of something like 1,300, 1,400 crores.
Yeah.
Credit card, which used to be negligible, is now I'm at a book size of close to 535, 40 crores, which is from scratch, which was almost zilch earlier. Gold loan, of course, is growing for us. Gold loan, even today, in my total advances, contributes to close to 19.5 to 20% kind of thing. And I'm looking at gold not as the area for growth, because it's a good area to focus on for obviously more than one reason. One, credit risk is zilch. There is no credit risk there. It's only a fraud risk or ops risk which we are envisaging in gold. And second is gold, as you know, you don't have to really provide for it, and you have zero credit loss. So that time it's a very good product. And since we are dominantly present in Kerala and Tamil Nadu, given our distribution strength in these states, which are predominantly gold loan consuming states, we are clearly leveraging that. But having said that, am I focusing only on gold? No, definitely not. Gold is one more product which I focus on. Clearly, it's a distribution led delivery product. Therefore, since we have a good distribution network, we are trying to push it like any other distribution product.
I want to get a couple of more questions in with regard to the liabilities franchise. Now, overall in the banking industry, there has been a sort of a run for a rush for amongst bankers to garner more deposits. In an environment where credit growth is rising so sharply, what is your assessment of deposit growth? How soon do you think that can come back and sort of track the current credit growth rates?
See, two things here. One is liability repricing, which is the need of the hour, will clearly happen. And depending on each bank's appetite for what they are wanting to grow their book, clearly the appetite for liability and the rate at which you raise liability will be very critical. So for a bank like ours, NIM is always very important for us. Therefore, we need to be conscious of the rate at which we raise our liability and the rate at which we lend our advances. So we need to be very sensitive to both. Having said that, you can't keep quiet and keep hoping that your existing liability customers will continue to have deposits, keep deposits with you despite your rates being low. That's clearly not going to happen. Therefore, you need to reprice your deposits clearly in tune with the market, and which we have been doing. And we are very carefully doing by looking at each of these buckets in which we are raising liability, and which is the significant bucket in which we are raising more liabilities, and how we can price it correctly so that we are not overdoing it, not at the same time we are not underplaying it too much that we don't raise any deposit. So I know that elasticity in a deposit is a very given thing. We need to be very conscious of the elasticity of this product, because the more deposit rates you give, you will definitely be able to garner more deposits. It's as simple as that. But then it doesn't make sense when you are trying to improve your NIM overall. You must be knowing that our bank had one of the lowest NIMs at some point in time of 2.6%. Clearly, we have grown, and my incremental NIM, the new product NIM, incremental new book which I'm creating, is at a NIM of 3.6%. Clearly, that is something which comes from the fact that we are very conscious of the rate at which we borrow and rate at which we lend. Sure. Therefore, to the question whether liabilities will catch up to the level of asset, I don't think so. It has to really catch up. I feel that each bank will have to weigh their asset growth strategy, will have to weigh their liability-led strategy, and will have to decide how they want to play it out. As far as we are concerned, clearly CASA, which is one of the big boosting factor for me to increase my NIM, which used to be as low as sub 25% before I took over, and now it is at about 34%. And my continuous thrust is to take it to 36% as a first milestone, and to improve it further as we go along. And therefore, it will be a mix of my CASA plus the term deposits which I raise. Today, I'm conscious that we need to reprice it, and we are holding more than one ALCO every month to ensure that we look at this deposit raising strategy carefully and we reprice it appropriately, so that we don't lose the track of continuous accretion in NIM, because that's very important for the bank of our size.
Okay. Lastly, I just wanted to get a sense about the growth of business for South Indian Bank. Going ahead, now that you have set aside some of the problems of the past, you're revamping your loan book, making it more fresher, taking care of the legacy assets, and focusing on liabilities franchises. What do the next 5 years look like for South Indian Bank?
Yeah, of course, next 5 years is too long a period really
okay, fair enough. Next year,
if I had to really look at it, see, I think the way I look at banking as a whole, having been in this industry for long, I think what is very important is to set the fundamentals and the basic blocks right. The basic blocks, as I see, is basically the things which have gone into my strategy statement, which is basically your CASA, capital adequacy, your cost income, your customer acquisition and customer servicing, competency, and capability building. I think these are all things which you need to keep working on, because the scenario, the ecosystem in the banking is clearly changing, and it is fast moving towards more and more digital, fast moving towards more and more granular, and people are almost like there is no limit to which you can go and source customers today, because digital has a presence and penetration everywhere in the country. But for all this to really be leveraged, I think you should have the fundamental blocks in place. So therefore, your quality of acquisition should be good, your quality of liability raising should be good, your CASA should be good, your cost income should be reasonable, and you should be present in various segments so that multiple engines keep firing. And even if one engine doesn't fire, it can be compensated with another engine firing. So you need to really put all these factors and build a bank which will be solid. I mean, this bank has been there for 93 years, and whatever I'm trying to do is to basically ensure that this bank is set for next 100 years of growth with the building blocks properly in place, and the bank should be agile enough to keep looking at what is changing in the market and to adapt those changes quickly so that we are relevant in the marketplace. So, but the immediate year, obviously for this year, the balance year, I'm looking at double-digit growth for the full year ended March 23. And definitely, and this is remember, this is the first year of, I would call, normal year, because the last 2 years have been COVID hit here, and we had a growth of only 4% in the year ended March 22. Now we are looking at double-digit growth for the year ended 23. I'm sure next year we will be like any other bank talking about, if things hold good, I'm sure we'll be talking about upwards of 15-16% kind of growth in the assets. And I'm sure the parameters, matrices, which will be critical for the bank's performance to be measured in terms of your GNPA, net NPA, cost income, your provisioning coverage, capital adequacy, all this will be in a comfortable range. And from then on, it's just doing more of it and really adapting to the changing scenario in the marketplace, in the environment. Capital, as you know, today as I'm talking to you, I'm at a capital adequacy of let's say 16.25%, 16%, close to 16% in my Q2. I would want to look at carefully whether we would need to raise capital, and if we need to raise capital to ensure that I continue to grow in my assets, what kind of capital I should raise, what route and how much. All that is something which is critical. And the more you set those issues behind, I'm sure you will be having a clear run. But one thing which we should never forget is that quality is extremely important, because in the name of growth, if you're going to compromise that, then you will have to keep correcting this again for the next 2-3 years. I mean, whatever correction which you are trying to do is correcting the things which were happening over the last, let's say, 5 to 6 years. Of course, not necessarily due to bank's own issues, but also due to the environmental issues like COVID hitting, floods hitting Kerala, and those kind of things. But
I'm sure,
and all the circumstances locally has to hold. That's where I'm.
It's reflecting in the way your stock price is performing over the last couple of weeks. We've seen significant rise in the price. Thank you so much, Mr. Ramakrishnan, for joining us on this conversation. Pleasure talking to you, sir.
Same here, sir. Thank you so much. Thanks for taking your time. Thank you so much.